Welcome everyone to this Market Thursday. It's June the 17th. It's 1 o'clock here in London. As always, a quick disclaimer regarding those webinars. Those are not investment advice. So this is for information. Please do your own research before doing anything. This is not investment advice. So literally, this is to help you. So welcome for those of you who are watching today and those of you who will be watching later on YouTube. I hope it helps. So very quickly, as usual, going through my background, started to work in the industry from 2000 as a cash equity trader in Paris. Then I moved to London in 2004, worked for 4 years for a hedge fund, both on the long only product and on the long short product. Then I moved to Infinity Capital Market, where I worked from 2009 to 2018, having an absolute return mandate, long short, a lot of stocks, a lot of Europe. Then I took some time off out of the market. I've been doing mentoring since 2014, and I restarted trading more actively since January, February of this year. So this is from my background. What are we going to be covering today? So today we're going to be doing situation across asset classes, as always, the 4 asset classes. We're going to be looking at the potential trade, which is a bit contrarian. We're going to be looking, obviously, because this is an important week as of yesterday, about the Fed and the macro, the positioning, the inflation, looking at expiry. So this is very similar to the webinars that I do every 3 months. The last one that I did in March, around mid-March, which is talking about expiry with a quadruple witching day and the index rebalancing. So if we look at the market action recently, there have been a lot of meme stocks that have been back and forth, like AMC, GME, which tells a lot about the lack of direction in this market. There is a lack of belief where we're going to go next. So if we look across many asset classes, as we discussed 3 weeks ago now, there is a lot of consolidation that has been going for the S&P, Nasdaq, many indexes, but as well for the bond market. So when the market is a bit not boring, but is quieter, people are chasing some volatility, and obviously GME, AMC, all those names, BBBY, that were heavily shorted, were over the last 2 to 3 weeks very much traded. Where for those names, obviously, I know that there are many retail traders that are watching those webinars. It is very attractive to play those names. Having said that, there is no fundamentals behind it. So it's very much like many Chinese stocks that are listed on the US market or traded in Hong Kong. We are not looking at fundamentals. We are only looking at the flows and the appetite from some retail and as well some hedge fund to play with options most of the time. So in terms of what we have from 3 months ago, it's again very similar. We had a big move in January and February, bonds, stocks, and since then we have been consolidating. In terms of macro, a couple of days ago, we had the retail sales number, which were a bit below expectations, but the revised were better. So all in all, that were okay numbers. There was as well the new permits, which actually were a bit below the expectations. So there is a bit of cooling down of the housing market from a very high level. The housing market have been very hot in the US for the last 12 months. So let's go into the price action. and see, sorry, not the price action, but how have been the performance so far. So if you've been following those webinars, this is something that is very familiar now. So the first part on the left-hand side, which is for the stocks indexes, almost every indexes in the world is up. So there has been clearly appetite for stocks across the world. If we look then at the currency in purple, it's always funny because if you read, if you go on Twitter, there is always a lot of noise about, the euro dollar, about the dollar weakness, the dollar strength. And actually, there has not been much over the last 3 months, 6 months. So the dollar is trading in a range versus most currencies. I'm not talking, obviously, emerging markets like the Turkish lira, but versus most developed markets. And again, this is not versus the Brazilian real. We are trading 2 to 3, 4%. In terms of catalysts that we might have in the future, that is for the market, for the bond market. Obviously, we have tomorrow the expiry that we're going to be discussing later. We're going to have as well, it's next Thursday on the 24th, the banks, the Fed bank stress test. So every year at the end of June, the Fed is making some monitoring of the several banks in the US, both the big banks and the regional banks, looking at their ratios, looking at their solvency, their profitability, and they will give or not give green light for their share buyback and their dividend program. So that's one of the drivers that we're going to have next week, keeping in mind that the earnings season is starting mid-July. As always, this is starting mostly with the banks. The banks have been coming down from high level, based on the US 10 years, the yields coming down again. So this is one of the catalysts. Plus you have the end of the quarter, end of the month, possible rebalancing after a strong first half for stocks. And you're going to have some rebalancing, not only the rebalancing that you're going to have for many indexes tomorrow, but for the Russell 1000 and 2000 and 3000. So that's, you're going to have some readjustment in terms of catalyst. Next slide, if I manage to do it. On a week to date, again, there's a lot of noise these days everywhere. But actually not much is really happening. So the S&P, and that's for the as of the close, as of yesterday, was flat on the week. What is interesting is actually Europe. That is something that we discussed 3 weeks ago. Europe is outperforming the US, which, if you have been trading the market for more than 6 months, is normally something that never happens. So if you look over the last 20 years, literally Europe never outperformed the US, but recently there has been interesting as well to see US flows coming into Europe. Last time it happened, that was when Italy, when there was huge expectation on Italy, and then that was a complete disastro sinistro. But again, a lot of noise, not really much happening. Bitcoin has been bouncing from 30,000 that we followed 3 weeks ago, and I think that obviously based on the volatility, there is a much wider range, 30,000, between 30,000 to 40,000. I wanted to discuss more the strategies around Bitcoin, but I think that will be for the next webinar, because today we got a lot to discuss. Interestingly, actually, gold was very weak yesterday, with real yield going up, and so gold went from 1900 to almost 1800 in one go. And WTI carries on its way up. Something, again, when we're going to switch into the technical analysis that we discussed, I flagged the $67 levels, which I told you, even if the fundamentals are not necessarily in accordance with that, I'm not going to be shorting this one because OPEC is trying to push the price higher. Next one is as always, the sectors. Left-hand side, this is for the year to date. Right-hand side, this is for the week to date. So year-to-date energy, like WTI, is extremely strong, up 50% on the year for H1. Financials have been doing pretty well with yield going up. Utilities, on the contrary, are one of the sectors that has been a bit struggling. And tech has been underperforming the overall market, not like crazy, but again, in a market where we have been struggling to identify leaders, technology is not as strong as before and pushing the market higher. On a week-to-date basis, you can see that materials are down 3% roughly. Interestingly, you had a lot of sell-off into commodities like copper came down, lumber came down massively. So the reflation trade is a bit slowing, obviously, and that's something we're going to see for the yields. And as well as we discussed in May, China is really trying to, or let's say, to limit a bit the access to credit and trying to limit the inflation coming from those commodities. There is obviously a lot of speculation into that space, which could be an issue for China, which is massively depending on imports for those materials. Next slide. So this is the 1 page go where we look at bonds. So bonds here, looking at the US, so this is in terms of bips. So bips means 100 bips equals 1%. So if you look at the year to date, more or less, the US ended the year in 2020 with the US 10 years around 0.9 to 0.95%, whereas these days is at 1.5 to 1.6%. Okay, so that gives you the 66 bips differential. And week to date, due to the action of the Fed yesterday, we had a move on the yields on the way up. So I think it's trading at 156 something. And again, we're going to be looking at the chart. Overall, the other markets, Europe and Asia, have been pretty flattish. The VIX has been up a bit. We recently touched the 16% level. So if you don't know to what it is equivalent to in terms of move, there is one video that I put on YouTube explaining the rule of 16%. So the VIX is at a very low level. Again, when I say low level, be careful. That doesn't mean that it's not going to go lower. It's just that we were coming from very high level last year. And very often when you go into the expiry, people don't take that much position and you get a dampening of the volatility. And that's something, again, we're going to cover later. In terms of top winners and top losers, you can see that there's a lot of dodgy names on the way up with the Bitcoin. Sorry for those who are long or short. And for the top losers, which tells you a lot about, what is going on in the market. Everyone is trying to find some direction. So there is, if you look at the ratio between number of tweets and what is happening, there is a lot of noise. Next slide, what are we going to do? So let's move into the technical analysis before jumping into the central banks. So here, let's start with the VIX because that is something that I discussed before. So VIX, we are 18.5% spot, which is a bit higher than, let's say, the last 5 days. But clearly, we are now below the 20% level. We get the VIX expiry, the futures contract yesterday. We get the big expiry tomorrow. And as I said before, very often market participants are reluctant to put new position before next week. So this is the VIX here. I want to be looking, as always, at the S&P futures and what is the chart telling us. So that is the weekly chart. Let's go into daily, if you don't mind. So the trend so far is still your friend. Okay, so this is the trend that we had since the election from November. It's still up. We are getting closer to some support. We have been consolidating between this 4100 and 4250 with no clear direction. So this is what you could call some distribution. Next move is going to be important, and really the market is looking for catalyst. Very often the market is rightly so driven at one stage by the earnings, and we have the earnings happening from mid-July. In terms of seasonality, June normally is not a very good month, but July is a very good month. I still want to believe that there is a chance that, and again, those webinars are not investment advice, that because of this gamma delta exposure of all that is coming off from Friday, you get a chance of, at least volatility to pick up a bit, and some selling pressure coming. If you look at the last expiry, which was in March, we got a very close call. So we got only a couple of days of selling. But again, in terms of what could happen in terms of flows, you could see some new risk on put on, or some hedging as well put on. For the Nasdaq Composite, so the tech stocks, we have been trying to go above this 14,200 level. It's almost a triple top. Actually, the price action yesterday was not that bad if you consider that, normally if yields are going up, you should have a huge sell-off in tech. Actually, if you look at this candle, it's not bad. So looking for leaders, it has been consolidating since March. No real leaders here, and the market is in a wait and see mode. Similar here with the Russell 2000, exactly the same story. Since March, consolidating. We got 200, 250 points trading range, 8 to 10%, and we have been consolidating into those levels. A bit of Europe, because really Europe is strong. So here we are looking at the stock 600. So in Europe, you get two main indexes. So you get the stocks 50, which is the 50 big caps, but it's very distorted sometimes by few names, and used to be very distorted by the banks. Now that they are smaller, it's not as much. So a better proxy is the stock 600. So this is the chart that you have here. You can be trading it with ETF. You can be trading it with futures. Actually, the size of the futures is not crazy, because it's roughly 22,000 euro. So this is the chart that I'm looking. So you can see if it goes around this level, you can imagine what you could be doing in terms of risk reward. So we are 1-2% from this high channel. Again, Europe is really, really strong. Another interesting chart that I didn't put here, which is as a French, looking at the CAC 40. So the French index versus the German index, and actually the CAC, which has been underperforming the DAX since 2000, has been outperforming over the last 6 months. Why? Because there is a lot of exposure. So in terms of talking, let's do a bit of charts. Let's look at the CAC versus the DAX. The DAX, okay, that would be the chart. Okay, so if we do a long chart and if we do a weekly, okay, is it my CAC versus my DAX? I should have something wrong here. CAC 40, CAC 40, and what is my DAX looking at? Do I need to put this one? I think this is the one. Okay, yeah, so here the chart looks, okay, so you can see the CAC has been underperforming since 2000. So imagine that I started to work in in 2000, and since then I've seen, you know, the French stock, you know, underperforming the German stocks. But recently there has been a bit of hope, which can be explained mostly by the weightings of three stocks in the DAX, which are LVMH, Kering, and L'Oreal. So a lot of luxury consumption, which has been outperforming. But overall, we have seen over the last 6 months some changes in the flows between US and Europe and inside Europe. Are we going to have a follow-up? That is always the question, but there are some drivers. Another chart that I find interesting, which is for the US, something that if you've been following me a bit, which is XLI versus the XNP. So that is the industrial versus the S&P 500, which I consider that this is a good indicator to look at the economic cycle. And as you can see, we have been testing the 0.25 level recently. That was at the end of May, when everyone was bullish on the US economy and about the cycle. So far, there is no confirmation based on that on a new economic cycle. So again, looking at those charts are always helpful. Finally, for the indexes, that is an idea that I've been working on recently. I'll try to do something more user-friendly for you to have a look. I've been looking as a contrarian trade as the transportation. So transportation has been really hot since the bottom in March. We know that the economies have been benefiting. There has been a lot. Transportation has been benefiting massively from lockdown because we were all ordering online. So the Amazon, the FedEx, the UPS were printing money. Plus, that was very true because of the freight. And so I look at it as a contrarian play, where I think the valuation have been pushed quite a lot. And I try to find trades that offers a decent risk reward. So here we are looking at the IYT, which is the ETF for transportation. You get 5-6 big names. You get a lot of train business that are involved in this. But I look at the September 2021 put spread which is the 265, 235. So for those of you who are a bit new to those strategies, is you want to have some downside. You think that it could go down, but with a limited downside. And the limited downside is for me mostly based on recent, or let's say historical downside, which I consider should be around 15% on a quarterly basis. So I look at the 265, 235. So the 265 put will cost me, that was 2 or 3 days ago, $10 roughly. 235, I will get a credit of $3. So overall, my cost is $7. With a max profit, what is my max profit? Is reaching the 235. So that will be making $30 minus the cost of minus the premium. So that gives me a cost of roughly $23, where my risk reward would be $23 divided by the initial cost, $7. So 3.3 to 1. So I think this is a decent trade. I'm not sure the catalyst is still there, so I'm waiting a bit the next 3 to 5 sessions. But that's something that I found interesting. I know that in the chat, in the community, we have been discussing, which contrarian trade to play, and which as well sectors that have been pushed a bit too much. So that could be one of the ideas. After stocks, looking at the US 10 years. So again, a lot of noise, but actually, if you look at what is happening now, we have been consolidating between the 150 and the 175%. Last week, I tweeted when it was at 150, and I was a bit surprised that it went below the 1.5%, but this is very often what happens when you get too much of one-way position, and as well when you get such a driver like the Fed, where you are shaking the weak hands. But so far, you know, even if doing technical analysis on yields is a bit of a fallacy, that gives you the idea where the US 10 years is moving. More interestingly, if we look at what happened yesterday with the Fed, is to be looking at the short end of the yield curve, which is looking at the 2 years. So the 2 years is now moving. So what the Fed has been doing pretty well so far is putting a shield and having, or let's say, keeping control of the short end of the yield curve. So up to 2 years and a bit further down. And now, as they said that they are monitoring the inflation, and actually that they see that inflation is coming, the 2 years is moving up in terms of yields. So that means as well that the yield curve could be flattening a bit. Why? Because there is a chance that the 2 is going to be moving much quicker than the 10. But that is the part of the yield curve that we should be targeting. Quickly, euro dollar currencies, because I know that some of you are looking at currency, and most of you probably have been starting with FX. I've been saying every month for the last 3 months, there is a lot of noise, no clear direction. So we have been trading between 118 and 122. I think many Twitter people yesterday, which were calling on the end of the dollar, have been pretty wrong here. There is no trend here. Again, this is consolidation. Obviously, the ECB is pretty happy to see some weakening of the euro, because, you know, if the euro would have been too strong over the summer, that will not help the European economies. But actually, yesterday was quite a big move for the dollar, and that's true against many currencies. We can do the DXY, we can do emerging market currency, but quickly I want to be looking at crude oil futures, and we are looking at next month. As I said before, breaking the 66.5, 67 level was a big level. So I played this first one, but I didn't play short the second one. I felt like the price action was too strong. In terms of where it goes from here, it feels very squeezy. I think the OPEC is very keen on squeezing everyone. But they made a very right comment, which is, you know, last year the big oil majors didn't make any investment. Okay, so they didn't make any capex. For those of you who have been working a bit in the industry or following the big majors, it takes 12 to 18 months between the moment you decide to do a project and you go online for the big majors, not if you go for Shell in the US. So if you consider that in 2020 there has been no capex, no investment, that means clearly there is a supply issue here. But I think on the other hand, OPEC must be very careful not to play too much and making sure that at one stage there is a bit of supply coming into the market. So here I have no view. The demand is still down 3 to 5%, so this is not a demand story, but it feels very squeezy. A chart that I found interesting, I know that some of you don't like chart, but if you don't like chart, switch 5 minutes further down, which is the copper. So here we are looking at the copper on a daily basis. We are talking at the log chart, coming from the 480, now at 425 something. It feels like confirmation of the end of the trend that started from last year. Good chance that we're going to have consolidation from here, but that we should not expect higher plays into those stories that were very played and much played by investors on the inflation trade. Finally, we're going to end up with the gold, which, as I said, is it this chart? Yeah, gold was very much destroyed over the last couple of weeks. Now it's running at 1780. So with real yield going up, that is not helping. Feels like a lot of noise, many retail traders pushing it, as I've been saying over and over. I'm not a specialist in gold, but the chart doesn't look like very attractive. Okay, let's go back into the central bank's balance sheet first, looking at the two, which are the Fed and the ECB. The chart is still the same. If you were looking at the stock, you will say that it's going absolutely banana, but actually it is going absolutely banana. Both the Fed and the ECB are buying many assets and putting a lot of assets into the balance sheet. So, and even if there are talks of tapering, it is still ongoing. So as long as it is ongoing, you know what is the liquidity story here. I had an email from someone, and hopefully you are listening today, about liquidity and how to spot liquidity and how to monitor liquidity, should I say. One of the good instruments to do it is looking at M2, which is the money that is circulating. You can go on the St. Louis Fed website where looking at M2 and build your monitoring on it. Let's carry on. Okay, so looking here at the euro-dollar curve, so we compare from 3 weeks ago when I did the last webinar as of versus yesterday. And we are looking mostly here at two things, which is the Z2, which is the December 2022, which was trading at 99.64 3 weeks ago, and now trading at 99.55. So clearly market participants are now expecting something to be happening in December 2022. What the Fed has been saying, and if you look at the dots from the Fed, even if Mr. Chairman Powell says that he doesn't like it, is Fed is expecting to do 2 times 25 bips rate hike in 2023. Again, we have been discussing that since January. Even if they were saying no, the market was saying yes, something is going to happen before. If you look at the September 2023, we went from 99.22 to 99.08, meaning that really market since the Fed meeting, and obviously since the May, has been increasing the odds of the Fed moving, and that is what we've seen as well when we look at the short end of the part of the yield curve. Clearly, we are expecting the yields to go up. So that means what? Some flattening of the yield curve. If we go into the next slide, which is looking at the, so here we get the euro-dollar December 2022. So you see the move that we have here, that is yesterday moves, which, you know, from one day to another look like a big move. But actually, if you look at the same chart since January, you can see that we are very much at the same level as we were in Feb and March. So again, since Feb, we have been consolidating in every market. We have been going up and down, But you know, don't read too much into people telling you today, oh, the Fed, there is a big change. Yes, there has been a change in what the Fed has been saying. And now the Fed is noticing that there is inflation. Surprise, surprise. Oh, yes, there is inflation. But market already in March was pricing those kind of moves from the Fed already. That is true as well if you look at the euro dollar. Struggling with that. With the euro dollar December 2023, which was at yesterday trading at 98.9, which guess what? Is the same level that we had in February, March. So a lot of noise, the same level. It's just that the Fed, as very often, you know, is adjusting to the market expectations, or what the market participants are doing. Here I took something that I found interesting, which is as a retail trader, you don't have any excuse by saying, oh, I can't have access to the research, to what the Fed is saying. You just need to go on the Fed website, put in your name on their email listing, and you will get exactly the same. And you look at here, and you look at the Fed projection. Okay, so the Fed projection, and I think what is interesting is that is for 2021, where we're going to have the core PCE inflation here. March projection in red. So in red, in March projection were before at 2.2, whereas the core inflation is at 3%. So what the Fed is telling us, forget about this, where 3 months ago I was wrong. I was wrong by quite a delta between the 2.2% and 3%. But trust me on the second part, which is, you know, expectations for 2022 and 2023. So here, really where the market is struggling is, you know, is it transitory? Okay, the question with transitory is like anything, are we going to be transitory for 3 months, 6 months, 12 months, 18 months? Clearly, based on the world reopening, the supply chain constraint, the calendar effect, we are in the middle of an inflation storm. Okay, does that mean that in 6 months we're going to have, sorry for my English, a shitload of inflation? Probably not as much as we have right now, but overall we're going to have inflation that first is going to be above historical recent average, okay, which has 1.5% something, and above the Fed mandate, which is at 2%. So clearly here there is start of a trust story, where is, can I believe the Fed, which even 3 months ago was telling us, you know, it's going to be 2.2%, whereas now it's at 3%. But keep calm, we got everything under control, because we know we are targeting 2.1%, and it's going to be 2.1%. So Fed projection. Next one, let's go back. So this is something that we've seen before, which is the break even. So more or less, this is the Fed inflation the inflation expectation for market participants, which are 2.36%. And again, very similar that we have over the last couple of months, 3 months. So a lot of noise, but market is overall the same. In terms of positioning, so you looking at the US 10 years, the CFTC positioning. Here there has been recently, so sorry, for those of you who don't know, you go on the CFTC website and you look at the non-commercial commitment of traders and the positioning. For the 4x4 video series, you know how to do it. For the other ones, you need to do a bit of research, but there has been some recent buying of what we call duration with, so that's the way up, which is equivalent to 120 contracts recently, and we are back to level that we had in October 2017. So if we look at the next slide, a bit of buying of US 10 years. So that is for the positioning of the market, which is quite interesting. If you think that if there is inflation coming, meaning that bonds will be selling, maybe there is some wrong positioning around here. So what does it mean? Sorry, in terms of implication for other asset classes? Again, this is something that I used 3 months ago, and I'm using it again in terms of rotation. And I like to be looking at rotation between small and big caps. So here, this is the SPY with the S&P and the SLY for the small cap. Since we had the election, we had a reversion to the mean, but you can see that we have been consolidating now for a certain period of time. Again, you can say you can shout on Twitter saying guys is going to go up, and the other guy could be is going to come down. For the time being, consolidation, it's going to move. Pick your winners, pick your losers. But again, so far more noise than anything happening. And for the growth versus value, you get more or less the same story where you get the consolidation here. Okay, so do we go here? Do we go here? That's a possibility that we're going to be trading sideways over the summer with no real catalyst. Next one, I want to discuss quickly the realized volatility, because we discussed the VIX, which is the implied volatility, and very often, obviously, the implied volatility is above the realized volatility by 3 to 5 points, and they go hand in hand. But what is interesting is the realized volatility for those of you who have been joining the market, let's say since 2000. I know that there are many retail traders that started to trade based on some checks, and as well some more time working from home, looking at the market and saying, oh, the volatility is obviously now very boring, not much is happening, which is very true. Here we are looking at the 10 days realized volatility, which is standing at 5%. So very, very low level. If you look at what happened before around that period, which was much higher realized volatility. Why? Because there was much more, let's say, uncertainties. But if you look at the same realized volatility 10 days over the long term, which is here since 2011, you can see that many times it could be around this very low level. So when you look at the chart, when you look at volatility, try to widen your time frame and not to be glued into just looking at the last 2 months, saying, oh, a couple of months ago it was like this. I can tell you that for me, this was nightmare time. Okay, nightmare time happened in 2017 when nothing happened. Implied realized volatility was implied volatility was below 10%. So be careful when people are telling you, oh, the implied volatility, the VIX is at 17, 18%. Realized volatility is very low. It could go lower. Okay, so try always to look at the long-term picture. So that was a bit boring. Now switching into what happens tomorrow. So tomorrow we get the Quadruple Witching Day. So this is a slide that I used 3 months ago. So on the third Friday of the month of March, which stands for the futures with the letter H, M for June, September U, and December Z. There is the expiry for stock index futures, stock index options, and stock options, and single stock futures. Those ones barely trade. So in reality, this is mostly a triple witching day. Why is it important for us? It is important because a lot of contracts are expiring tomorrow. So as those contracts are expiring, both investors are not necessarily hedged or have direction, and as well the market makers who are taking the opposite positions have many positions that are dying tomorrow. Sorry for the noise in the background. So are dying tomorrow. So tomorrow what you're going to see is, first, if you look at the chart, you're going to see a huge volume stocks, index, everything. So which going to be distorted. So don't tell me, oh, this stock has been moving like 2% on Friday. The 18th, yes, it moved big time because of the expiry. But that means because you have large open interest of both speculative and hedging position that has been exacerbated over the last month, which is true. That was even more true from Jan to March, a bit less true in terms of call options. But you can argue that many single names like AMC, GME, so the gamma-driven stocks, many positions will be dying tomorrow. If we think, and we're going to look at it later, weekly expiries are even more important than they were before. But very often what it leads to is to new, volatility, possibly new volatility conditions, okay? So very often what you see is a grind into the expiry. Here there is a lot of open interest on 42.25 and to 42.50 on the S&P, which is a bit higher than this. But you're going to have new Greeks to put in place. And that's really something that we always need to be checking. When is the expiry coming on this third Friday? Technically, this is for the SPX options versus the SPY options, just to let you know when they are expiry, because it does matter. And at the bottom, this is for some European markets, when those European markets are maturing, expiring, sorry. So you'll be looking at for the Swiss market and the Italian market on the open tomorrow, where you can be checking if you long Unicredito, for instance, there's going to be a huge print of Unicredito on the open. If you're looking at Nestle, there's going to be a huge print on the open. Whereas for the Euro stocks, is between 10.50 and 12. And for the German DAX, it's going to be between 12 and 12.05. So there's going to be, this is UK time, all of this. So there's going to be a huge auction. And again, maybe there are trades to do. As a trader, those are the free tickets that you'll be looking at. Sometimes it happens, sometimes it doesn't. But when it happens and you can be making 2 to 5% literally in 2 minutes, it's always good to take it. What I found interesting here, this is from Goldman Sachs. Not because this is coming from Goldman Sachs, but this is the different option expiries. So since 2016, so if you look at the chart here, the CBOE has been introducing weekly expiries. Okay, so 10 years ago, so in dark blue, you can see this is the size of the third Friday, the monthly expiry, and the monthly expiry size have been slowly but surely coming down and is not as important as before. And the weeklies here are getting more or less the same, but the Monday, Wednesday weekly expiry are pretty big. So there has been, in terms of market structure, and for me, it took me a bit of time because I'm a bit slow to understand those things, but I remember before, I was always looking at this, this is the quarterly expiry, this is the quarterly expiry. Then slowly but surely, those quarterly expiries were not as important as before. And you could tell that the Monday, Wednesday expiries were getting bigger, okay? So the drivers are moving. Still, this quarterly, especially the June one, is a very big one in terms of size of book. I think I read somewhere, I think it's one of the, in the next slide, because I don't want to be saying some, that will be later, but here, this is the size of the June 2021, which is in this one, so that will be here. It's not as big as the other one. Last year was a pretty massive one, but still this is significant level. And reading some, this is here. So reading from some research from Nomura for this expiry. So the S&P Gamma is now at 40% expiring, and Delta drops to 54%. And for the QQQ, which is for tech is down by 53%, roughly 50%. So that means from tomorrow, you're gonna have a reset, or if you think about your risk appetite, if you get a book of 100, you get 50% of your position that are dying tomorrow, and meaning that from Monday you can putting some new position at work. And that's true for market participants, as I said, and for the market makers who are taking the opposite position of yours. So that is for the option expiry. Then, as always, going into the option expiry, there is it comes hand in hand with the index rebalancing. That time I tried to explain it a bit better. So what is index rebalancing? So index providers regularly overview the composition of the index to make sure that it's follow their methodology. So for instance, you're going to say, if you are in X index, you need to have X percent of your float. If your percent of your float is going up because let's say one shareholder has been selling 10%, that means normally the weight of this stock in the index should be higher. With the same idea, if you got a new stock that is IPO'd, so a new introduction in the market, this stock was before, as it was not listed in the market, suddenly it could be following and meeting the rules of this index, and then it might enter this index. So index funds and many ETFs are supposed to follow the different weightings of those index, and will have to adjust their portfolio based on the changes discussed and decided by those different indexes. So very often what you see is, for these expiries on the third Friday of March, June, September, December, will come many index rebalancing. Not all of them, but many of them. And you're going to have mostly four cases. Either you get an addition, so meaning you were not in the stock was not in the index and it's entering the index, or you get a deletion, meaning the other way around. You were a member of this index, but the committee member decides that you're not meeting the criteria to be in the index, and you could have a weight increase or a weight decrease in the index. Why is it important? Because obviously that there is a lot of flows going and following those indexes. That is even more true due to passive investment. Due to passive investment, many investment funds, mutual funds, and index funds are following those indexes, and will have to follow the rules and the weightings exactly as the committee is saying. So here I took the example of the stock 600 because it's pretty easy. And so those are the names that were announced at the close, after the close on the 1st of June, and which will be effective at the close of Friday tomorrow, or open on next Monday. So in red, we have the names that are added to the Euro Stock 600, Stock Europe 600, and in green, sorry. And here, those are the stocks that will be deleted. What is interesting is, and that's something that I put in the community. So we have a community that we are trying to build, and when I say we, is, you know, with the people that join the 4x4 and as well the mentees. We are trying to build a community and sharing ideas. So here you can see this is one of the ideas that I was pushing 14 days ago, right after the announcement of this rebalancing. Clearly, we were looking at this stock, ALFG NA, which is a Dutch listed stock, which has been recently IPO'd, and due to the low volume of this stock, that meant there was a huge buying pressure. There is a huge buying pressure expected for those different funds to replicate this index. So if we look into the next slide, if here this is on the 1st of June, where you can see that all funds were announced to be added to the stocks Europe 600. And that will be, as I said, effective from the open next Monday. And you can see the ride that the stock has been having. So you get three ways of playing those rebalancing. Either you are trying to forecast which stocks will be entering or will be deleted from the indexes. So you are playing them before. So that's strategy number one. So that's from here to there. Then we get the strategy number two, which is the flow that will happen between the moment it has been announced and the moment it's going to enter the index. And then you get the last strategy, which is on the day of the change, which is tomorrow. So tomorrow at the close. So for those of you who are trading Europe and in the UK, so that would be from 4:30 to 4:35 or 5:30, 5:35 continental time. You can make sure that you're going to have some funny auction prices. And so if I were you, I would be closely monitoring this ticker. There's a possibility that it's going to be moving big. And if you can find some bow, if it prints higher, maybe it's worth, but it's not the name only. So here we are talking about special situation. I strongly advise you to be looking at it. You don't need to be necessarily that smart. You just need to be ready. Quickly going through the product that I'm trying to help you with. So as I just mentioned, community is starting to get bigger. So I'm very happy to have, and I thank you, all of you, to participating. So at the moment, we get the 4x4 students and the mentoring students. So it's divided. I think I'm going to be probably in September putting everything together, where we try to find long IDs, short IDs, comments, risk management infrastructure. It works pretty well. I'm happy to start to see some traction here. Second thing that I do, which is the 4x4 video series. So it's 40 plus videos that I've been building based on my 20 years experience, both as a long short, long only prop trader, based on my 6 years before doing some mentoring where people were struggling with different products. So we are talking about top-down, bottom-up, special situation, active trading, where you're going to have 50 Excel plus spreadsheets, where you're not going to be paying, some other guy to give you some research. So this is to build your infrastructure, to manage your own money, and if you want to have access to the industry, I think that will help to get a professional process. Then the next step, or another step, will be the mentoring program. Which is 12 sessions on Skype or Zoom, where I help you, similar to the 4x4, managing money, managing your own money, building your infrastructure, learning how to trade real money in real time, where we're going to be looking similar to what we've done today, top-down, bottom-up, active trading, special situation. I think it works very well. I'm very lucky to have very good mentees, and I'm really benefiting as well from what they bring. So it's a good thing. It's a win-win situation. Do you do a question from Andrew? Do you do refresher courses as well? So in terms of I try to tick the boxes with the webinars as well. So we have the infrastructure with the 4x4. Still, there are some stories that are going to be developing, and some things where we might be struggling, and this is why I do those webinars. The Excel spreadsheet are updated as much as possible. I think they are very user friendly. You're not going to be struggling too much with them. So this is more or less what I do. What time is it? Okay, yes, 60 minutes into this webinar. So I hope it helped today. If you get question on what I discussed today on the 4x4, on the mentoring, so when mentoring, I have newcomers, so it's picking up. If you get some desire to do the mentoring soon, please come to me quite quickly, because the seats are limited, because I just want to make sure that everyone is happy, and I can do something good with your process. Any other question on that you'll be asking, you can find me on Twitter. If you like what I do, tell people about, or like it on YouTube, because it always helps, and that gives me a bit of a smile. And otherwise, be careful as always, follow the risk management, and hopefully we're gonna have some catalysts going forward. Market was a bit boring over the last few weeks. May was a good month. For me, this month is flattish, and as any trader and a French, I'm always complaining and looking for more. So thank you for joining, and normally I should do one in 2 weeks' time. Thank you very much. See you in 2 weeks.